Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another fine week. Actually was a pretty good week. And before I get to the rest of today's program, I'd like to take a second to direct everybody to my website. A couple things there. There's a seminar to sign up for. Seminar is going to be relatively soon. In fact, I always forget to look at this stuff before I actually start talking about it. It's pretty funny. So I'm going to pull it up myself. I'm going right into the website, and it is Thursday, March 16th. So the day before St. Patrick's Day. Woohoo! Anyway, 7 o'clock at the Corporate College East. You go to my website, learn more about it. But we're basing this one off of a book that was written back in 1949, or was published in 1949 by Ben Graham. If you don't know who he is, he was Warren Buffett's graduate school teacher and first employer. Warren Buffett worked for him on a private fund that they ran. And today they call them hedge funds. Back then they just called them partnerships because that's actually what they are. Anyway, he wrote a book called The Intelligent Investor, and basically he's considered the founding father of value investing. And I've just kind of updated that book a little bit, brought it up into the current. A lot of the same concepts still work. And actually, they work about the same as they did back then. And the market is really not all that different. It moves a little faster now in some cases. There were a lot of stocks back then that used to fly. I mean, they would go up several 100% a year and then turn around and crash. You'd see the same types of activities that you're seeing today. Stocks that sold well beyond any fundamental measure could justify. That happened back then. Actually, it was probably more common to happen back then than it is today because there's slightly more information out there. But hope does spring eternal. Anyway, how does all this matter? What does this matter to you? Well, first of all, as an investment option, your options have become severely limited over the past few years, a couple decades actually. Fixed income, CDs, bonds, government bonds, those are at such low yields right now, it's really kind of taken them out of the picture for any real sort of return that you might want to get. Now, I will be talking a little bit about some CD or money market alternatives that have market risk, but not a ton of market risk. And we'll be talking about that at the seminar too, because I get questions on that almost every week. Somebody asking, I've got this CD maturing. What do I do? But I need it. It's my emergency fund. Okay, here's the good news. You can invest without risking losing half your money. Here's the bad news. It's not going to pay very much. And if anybody's telling you differently, they just don't know any better. So, or they don't want you to know any better. I'll give them the benefit of the doubt. I'm just going to assume that they just don't know any better. But we're going to be talking about some of those alternatives at a 1.5% interest rate. It's better than a money market, better than a CD. Does it have some risk? Well, yeah, it's got credit risk. If the creditors can't pay that money back, you've got a problem. It's got liquidity risk. If there's a big run on the market, then just the fact that nobody's buying these things could cause the prices to go down temporarily. But I will tell you that a lot of these things are items that they used to put in money market funds until the Graham down. That may get. I'm always messing that up. That rule, by the way, that'll get changed potentially. Here over the next year or two, the way things are going. Dodd-Frank. That's what I meant. Graham and Dodd was the name of it. Another book by Ben Graham. The Dodd-Frank Act disallowed certain investments in money market funds. And so they've created small funds that invest in those same things that used to be in all the money market funds, AAA rated, very short-term maturities, very liquid, and now they've opened up these funds to take the place of what used to be in a normal money market fund. Now, if they lift the restrictions on money markets and they're allowed to go back into those types of investments, I'm not sure what this fund's going to do. I mean, it'll still be there. It'll still be paying around the same thing, but then a money market will be paying the same as it, basically. So, and there's no sales charge to buy or sell it. So that shouldn't really matter too much from the investor standpoint, because you can just switch at that point. So we're going to talk a little bit about that, but I'm really going to spend a lot of time because today more than ever, it's very important that you be an above average investor. And I know if everybody on the planet, by the way, all of a sudden did the right things at exactly the right times, there would be no chance of being better than the average investor. But that's not the case. The average investor does not do well. There's a company called Dalbar. If you've never heard of them, Google it. Buy one of their studies. I'll actually bring the latest copy with me. I'll bring the most important page that shows you what the average investor's been doing. And the average investor never makes a lot of money. The average investor is not hard to beat. And if you're going to retire at some point in time, or if you just want to quit your job and live off your investments, and which I call retirement, but that could happen for you if you're 40, if you've got enough money, if you're 30, if you're 20, if you win the lottery, but you got to have a lot of money to be able to do that. And then you have to be an above average investor. So Ben Graham was definitely an above average investor. I read somewhere Warren Buffett had calculated his lifetime returns, net of his fees, by the way. Those guys got 25% of the profits that they earned above a certain benchmark that they choose. I think it was a 10-year treasury at that point in time. So their management fees were hefty. And his lifetime average, according to Warren Buffett in an article, and you'll have to Google that too, was 14.5%. That's pretty good, especially when you think about, that was back in the through the Depression, where he suffered huge losses. Everybody did. To have come back from that and had that type of a track record, that's pretty good. So anyway, a lot of those same concepts, they still work. They still work. And we're going to be covering them in this seminar. It's free. There's no cost to attend. Just go to Bullington Capital. And we're going to talk about those concepts. I'm going to bring them up to date. He talked a lot about the dividend yield. In fact, in that book, I'm pretty sure, I just had to rebuy another copy of it. Now I want to see if I can find one of the original, because they've added, several hundred pages to it, and it's not Ben's work, it's somebody else's. That really ticked me off, by the way. Anyway, it talked about, the yield should be at least as high as a 10-year treasury, which back in those days was 6%. So if you're looking at a stock with a dividend, he was telling you not to invest in stocks that didn't have dividends that were at least 6%. Well, that doesn't exist today. But I'm pretty sure if I said, hey, look, what if I just used the trailing dividend yield? I know he'd have a couple of problems with that, but I think overall he would agree with it. What if I said, all right, forget that. I'm going to use the new BCAP value model, which incidentally, I have the very beginning explainer video on. It's like 30 or 40 seconds, just telling you that more explanation is coming, that this is a new model, and it's based on a lot of the concepts that Ben Graham talked about. We're looking at how much operating income a company's generating. I'll get back to that later in the show, because I did have somebody email in and ask a question about that. A couple questions, actually. And anyway, operating income from operations is basically a really, really rough estimate of how much cash you have before you have to pay taxes and interest on any debt that you have. Okay, so but it's a pretty good number to use. You don't want to use it. I wouldn't want to depend solely on that, and I don't. But it's a good starting point. And I'm sure it's something that anybody who's value oriented would agree. Yeah, okay. If they don't have any operating income, that's really risky. If they're not making any, if they can't cover the cost, the basic cost of their doing business, they're going to go away. Okay, so that's all we're really looking for there. Operating income. How much have they covered their basic costs by? Do they have any operating income? Is there a profit there? The company's not profitable. Let's wait until it's profitable. And I know people go say, well, what about Amazon? What about Facebook? What about all those internet stocks that came in 1999 and then went bankrupt before they actually turned a profit? That's my response. Yeah, what about those companies? What about all the ones that go bankrupt before they ever turn a profit and go away and take all your money with them? So this value investing is not speculation. You're looking for value. You're looking for companies that are generating cash. That's where you start, but only if you want to be relatively conservative. Relatively conservative. Van Grime used to talk about a margin of safety. He also talked about how volatile stocks were. And you have a margin of safety. He didn't say guaranteed safe. He said you had a margin. And he was looking for stocks that had a large margin of safety. You hear that? Not a small, thin sliver of a margin of safety. A large margin of safety. So how do you figure that out? We're going to cover it. It's not as hard as you think, by the way. Pretty easy, actually. Especially when you've got modern tools the way that I'm sure that guy would have died to have access to the types of tools that we have access to today. Because he had to hire 4 people in his office to sit down and go through the financial reports one by hand. That was brutal. And that's actually what Warren Buffett was doing. Warren Buffett was doing that for him. Was going through one by one, doing these calculations by hand. So was Walter Schloss, another great value investor. He had a lifetime track record that hardly anybody's matched. In fact, his lifetime track record's almost as good as Warren Buffett's, by the way. Nobody ever heard of that guy. Very, very quiet, very meek, mild-mannered. Anyway, those concepts, they work very well, and you need to know this stuff. I mean, you don't have to know it as well as I do, but you should become familiar with it. You should get the basic ideas, just the major points. Why? Well, because you're probably going to have to be an investor at some point in time. And otherwise, to try to make it, think about this. You got a 1% CD. 1% CD, by the way, that's taxable. You're not going to get the full 1%. You're probably going to get 0.7% after taxes. But let's ignore taxes for a minute. 1%. So 1% of $1 million is $10,000. That's it. And then, by the way, you're going to have to pay taxes on the $10,000. So to generate $10,000 in income, you need $1 million. And actually, you need more than $1 million because that's a pre-tax number. So that's why this is so important. You're coming up on retirement. If you're not thinking about retirement, you should be. In fact, the cost is so high today, you should start teaching this to kids when they're 12. You should start teaching them about, getting a part-time job or a paper route or selling something on Amazon or eBay, and saving part of what they make before they get out of high school. Actually, you really need to talk to them about it before those hormones kick in, because you won't be talking to them until they're in their mid-30s when that happens. Because they will not settle down. You got to get to these kids when they're, before the hormones kick in, and hopefully they don't start kicking in too much earlier than 12. But a lot of 12-year-olds get it. They've already had enough math in school, by the way, to be successful financially. They have. You don't need calculus. You don't need trig. You don't need statistics. Statistics help, but you don't actually have to know them. All you really need to know are percentages. You need to get really good at that. So that's what will be all those things we're going to be covering at this workshop. I will talk a little bit about the Look Out for the Bull website as well. That's still up and coming. We've got to get some legal things done to make sure that we dot the I's and cross the T's. You don't want to get in trouble with the SEC. That's you don't want them knocking on your door. So just be patient with us. We are working on it. We work on it every day, at least a little bit, sometimes a lot, and it's coming. So, and it's exciting. I'm going to be glad to see it. I think in fact, later in today's show, I'll talk to you about some of the stocks that are coming up on some of those scans. And trading and investing, by the way, I still get people that get these confused. Two entirely different activities. They both involve stocks, But an investor is not interested in much that a trader has to say, and vice versa. The vast majority of traders can't stand listening to a boring story about somebody's financial statements or what the business strategy is going to be. They really don't care. So they both operate in the stock market, but they do two different things, completely different. And I know a lot of people, want to try to marry that. And I used to be that way. It used to be a lot easier to do. You used to be able to marry the fundamentals to the fundamentals are things like sales, profit margins. What do you think the business should do? There's a lot of flack that Starbucks is taking right now because their business strategy is to get people to call these orders in over the phone. Well, those are log jamming the lines at the Starbucks stores. So everybody's going, hey, that's not a good idea. And you're starting to see a little drag on sales growth. And that's what an investor is interested in. An investor likes to hear stuff like that. A trader couldn't care less. He's not going to be there long enough. And they're typically, it's funny, when I was early in my career, these guys didn't even like each other. They wouldn't go to the same conferences. They were always getting in arguments over who's the best. And I'm like, I don't know. I've seen people who have done well in both arenas. And I will concede, when you've got $1 billion, you're going to have to become an investor. The market's not that liquid that you can trade like you need to earn halfway decent returns without taking too much risk. So when you're super successful, when you got $1 billion to invest, first of all, call me. But secondly, you won't be able to trade anymore, except you can take a smaller portion of that and trade. But trading's something that small funds do. Big funds typically don't do that. And a lot of Fidelity funds, those guys were traders. They wouldn't come out and say it because that had such a negative connotation to it. But I used to watch turnover in their portfolios, and they weren't trading based off of charts. They were trading based off of fundamentals. And they would look for certain things, develop certain expectations, and then they would trade it. If it got to the price that they wanted it to, they were out. If something happened to change their opinion, they were out. Okay, so a lot of turnover. And again, that's one of the things that confused an awful lot of people, me included. I've made every mistake you could possibly make as an investor at some point in time because we all start new. I hear the music. That means I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Wow. I just read so much during that long commercial break that I forgot what I was talking about. It doesn't really matter. Hey, rest of the show, we're going to talk about two things. First is the upcoming workshop, how to invest like Ben Graham. Actually, you're just going to update a lot of his strategies. I've built a couple models based on things I read in the book, The Intelligent Investor. So I'd like to talk about that. That's March 16th, 7 o'clock, Corporate College East. We'll always spend a few minutes talking about trading, too. Again, I was talking about how those things were different. Now it's coming back to me. And two different activities. Both of them can be profitable. The trading activity is significantly different than investing. And I like to do a little bit of both. Actually, I like to do a lot of both. And it's fun. I even like the investing part. I just put a portfolio together. It was hilarious. One of the stocks in the portfolio went up 30% in the first week. Another one went down 30%. It's a good thing I got 50 of them in there. Which is also something we'll talk about. You can build portfolios. You can have 50, 60, 70. You can go up to 100 stocks with as little as $1,000. Think about that. There's this firm out there called Folio Institution, one of my custodians, and they allow us to buy fractional shares, pieces of shares. They don't charge commissions. It's a flat fee, so you can have unlimited transactions with certain restrictions. The restrictions are, by the way, that you have to trade during what they call trading windows. You have to make your transactions your buys and sells during these trading windows. So you tell them what you want, what percentage you want. It'll go off at 11 o'clock or 2 o'clock, whichever one you choose. And there are no commissions. And they track your performance. And it's a beautiful thing. I really like it. In fact, we'll bring up some of the models that I'm using. I'll just tell you right now, I'm using Folio to execute them because you can't execute them at other firms. Right now, they're the only one. They're the only firm that you can do this with. And I keep threatening to tell Fidelity, you should go over and buy these guys. But I don't know. Fidelity might buy them and just put them on the shelf to take them out of to take the competition away. I have no idea. But very, very nice firm. And you can basically create your own mutual fund. Creating your own mini mutual fund. Why would somebody want to do that? Well, because mutual funds that are run by real people that are doing this not on a quantitative basis, that means they're not using computer screens to run it. They're actually trying to think about it and pick stocks. A lot of them have a really tough time keeping up with the performance, staying in the top 25% of their categories. They have a really tough time doing that. And for reasons that are well beyond the amount of time I have left on this show, maybe we'll talk about that in the future. But let me just tell you that a fund manager that gets into the top 25% of his fund category for performance has an incredibly difficult time staying there. And the number one reason, incidentally, is size. Mutual fund has a great performance, and that fund will get huge. And there are only a fixed number of stocks to invest in, so they have to buy a larger and larger pool of them. They're not buying a lot of stocks because they want to, but because they have to. Does that sound like a great recipe to you? Yeah, that's why it's so difficult. It is really tough. That's tough to do. So I get it, and I understand that. That's why I like to use fairly simple mathematical models, like the ones that Ben Graham used. Ben Graham was actually the first quant. That's the nickname for somebody who is a quantitative strategist. He was the first quant ever to manage money in the stock market. His principles were laid out in one of his in that book, actually. But he had guys, because he didn't have computers back then, so he had guys going through the financial publications of the day, the Standard & Poor's reports, Value Line, when that came out. I guess Value Line was probably after that. But basically Standard & Poor's, Moody's used to do a lot of the same kind of stuff. They would go and they were looking for certain criteria. When the stock had that criteria, they would circle it. Yep, we're going to come back to this one. Then when they come back to it, apply a few more tests, and it was either yes, it's in, or it meets the criteria, or no, it does not. And that was basically how he ran the money and did as well as he did for an extremely long time period. That's where Warren Buffett first learned to pick stocks. So that same type of system, so those same types of methods for searching out companies that may have the potential to go up a lot and trying to minimize risk. See, that's a key, trying to minimize risk. Again, he talked about it as a margin of safety. And I'm going to show you how to apply a margin of safety. It's not that safety is not the same thing as guaranteed, by the way. You are guaranteed that they're going to fluctuate. And he talked about that too. There are a lot of things he said that he was so far ahead of his time. You get some people like that. They're just so far ahead of the rest of us. Tesla, back in the early 1900s. And I would say Elon Musk, and today, Steve Jobs. Those guys had visions of the future, and then they turned around and started getting the entire economy moving in that direction. And oftentimes, they weren't their own visions. And I was just laughing about this with Alan Bricado, a good friend of mine. He's a home loan officer at UCFC, and it's Home Savings. I know it by the symbol. I know the symbol before I know the stock, before the name of the company. That's pretty wild. So anyway, we're talking about that today and how so few people come up with new ideas. If an idea is 1% new, you can make a lot of money with it. If it's 10% new, you can get rich. Let me explain what I mean by that. So Steve Jobs never really created anything. There were already computers before before they even started thinking about making one. There were already MP3 players before he came out with the first iPod, which, by the way, saved Apple. They were on the brink of extinction. They were losing money. They were going out of business. And iPod saved Apple. And Business Week magazine, I forgot what date it was, but you can Google it, runs a headline, iPod can't save Apple. Right when it started to turn around and kick in, and it saved Apple. And anyway, people forget that. They forget that, Apple didn't invent the PC. They didn't invent the mouse. They didn't invent anything, really. They took really good ideas, and they improved on them. Like I said, 1% new. So what was happening with Apple back when it was struggling? Well, a lot of the products weren't selling. They just weren't selling. And actually, Steve Jobs had been fired. The new guy didn't have the imagination that Steve Jobs had. Couldn't see the ideas that consumers might want. Had trouble developing them. So they brought Steve Jobs back. Steve Jobs goes to work right away. Says, hey, I think they'll like this. And had a knack for that. That's something, by the way, you can't measure. You can't measure somebody's knack for being able to identify things that people are going to want. But beyond that, when Apple was selling for below its net current asset value, that would have hit one of Ben Graham's screens. He would have bought the stock. The split adjusted cost basis on that is about $1. That would have been the split. Last time Apple traded below its net asset value, your cost basis would be $1. Apple was $120 last time I looked at it. How many of those you need in your lifetime? Yeah, but anyway, so that would have shown up on one of those screens. In fact, it's in one of the models now. The Bullington Capital, the new one, the BCAP value model, the one we just cut a little short video on, it's in there. So I got to take a real quick phone call here. By the way, if you'd like to call in, 216-901-0945, 216-901-0945. And I got Phil. Phil, how you doing?
Yes, good morning.
Morning.
They wanted to get your take on President Trump's decision to roll back the fiduciary rule that was slated to go into effect here this spring.
Probably a bad idea. But see, I've always had to operate under that rule. They were just going to apply that to stockbrokers. So if you're a registered investment advisor, you have to put your client's interests ahead of your own. You're not allowed not to. So I've been operating under that for a very long time. I thought it was about time that they would apply that to everybody, not just us. And I thought it was a great idea that they rolled it out. And I'll be sad to see it gone, because there are going to be people that are, they're going to get sold products that are inappropriate, and they really won't be able to do much about it.
I mean, the rule seems so much like it's so common sense. I mean, I don't understand why Trump's taking this position.
There are some huge lobbyists, and they spend a boatload of cash. So, and they also generate tons of commission. And they just don't want the rules. It restricts their ability to sell these products. So there are a lot of products out there. If a product sounds too good to be true, it probably is. And those are the types of products that they want to try to get rid of. And you see them all the time. I see them constantly. In fact, one of the worst products is one of the equity indexed annuities. I see at least one of those a month where somebody shows me they've had that product for 5 or 6 years, and their surrender value is less than what they put into it from 6 years ago. So that's a lot of net worth. And this is how dumb this is, because if they repeal that, they won't be selling those products anymore. If you had put your money, even 20% of it, into a crappy mutual fund that invested in stocks over the past 6 years, it'd be worth more than that annuity is. And by the way, when somebody dies, that gets taxed. So all the tax revenue they're losing by not having that law in place it's a big deal. And that's why, it doesn't make sense to do it, really. Everybody, the entire business, the whole financial services industry should have been started that way from the get-go. You must act in your client's best interest, not in your own firm. At the firm first. There was a joke around every brokerage firm I'd worked for, because I used to be a broker. That's how I got started in the industry, until I figured out that, this ain't too cool.
Mm-hmm.
When people are going around and saying, hey, the firm made money and the broker made money, 2 out of 3 ain't bad. That was that was a joke that actually literally would go around brokerage firm offices. That's not very common anymore, by the way. Even the big firms have moved away from that, but it's still there. It's still there, and they're very strong because they've lobbied to keep this, try to get this law repealed.
Yeah, well, it's obvious. Though. Wall Street owns the politicians.
Nah, they don't have that much money. Nobody's
Thanks,
that
Bill.
rich. Yeah, have a good weekend. Thanks. Yeah, you got to go to Jerry. By the way, if you want to call 216-901-0945. Jerry, how you doing?
Good morning, William.
Hey.
Hey, before I get into what I originally called you about, I was going to say in this fiduciary rollback, I also have to say it's kind of difficult to prove a non-fiduciary situation. It's kind of like taking a double negative position. How do you prove somebody acted in a non-fiduciary standpoint?
It's
seems
pretty
like
easy. No. It's really easy. When you see,
well, for a scam artist or a snake oil salesman, but how broker may have sold you Verizon, and Verizon's taken a whooping.
That's not what they're talking about. They're talking
Please elucidate.
Yep. They're we got an echo here for some reason. Okay. What they're talking about is somebody that sells somebody an annuity that's got a big sales charge. It's hidden. They tell them that there are no fees, and then they'll come back 2-3 years later, convince them to take another annuity that pays a bonus that will make up for the fee that they're going to get charged when they do the exchange.
Mm-hmm.
And they're probably even transferring less money over in a lot of cases, some cases not. But they're getting paid again on a product that has super high expense ratios.
Right.
And they're just slowly, continuously losing money.
But Bill, isn't that fraudulent or actually? I mean, I would think if you're telling them that you can't, that there's no fees on it, and then fees show up a couple of years later. I mean, obviously they knew that.
Oh yeah. That's against that is against the law. But I'm here to tell you that it happens. It happens every day, absolutely, and I see it. In fact, I wanted to take this flyer that came from an insurance company that one of my clients showed me and send it to the State Department of Insurance of Ohio. And I told them, they said, no, we don't want to do it. Like, what? What do you mean you don't want to do that? You need to turn these guys in, and they make everybody look bad. They make everybody look bad.
That's outright deception or fraudulent.
Absolutely, it is, and it's going on.
Okay. We were looking at it from a more of a rhetorical standpoint. I understand what you're saying, but I thought it had to deal with selling making a poor stock decision or something of that nature. That's not the case at all.
Right, but if you were to put, and here's the thing, if you were to put somebody into a stock, any stock, doesn't have to be Verizon. Any stock is extremely volatile. They all are volatile.
Of course.
So if you put anybody in a stock that didn't know that ahead of time, let's say you put a child who had a guardianship account or a trust account, and you're putting in a bunch of biotechnology stocks that don't have any sales or earnings or even any products that have been approved yet, and it ends up losing a lot of money. Now you're responsible. Does that make sense?
Yeah, it does. I understand. As I said, I was looking at it from a different perspective than you were.
I'm going to take a real quick commercial break here.
Okay, could I hold?
Sure. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
Running down the road, trying to loosen my load. I got 7.
And we're coming back. And before I get that, not everybody that has an insurance license or a securities license is a participant. I want to make that very clear. A lot of them are doing really good work. They do take their clients' best interest at heart. But, you've always got that small group of people out there that just want to bend the rules and are only interested in making as much money as they can for themselves. And that, that's with any industry. So I don't mean to be too negative on that, but you just have to be diligent. Just kind of stay tuned, keep in touch, always question, always ask, get multiple opinions, all that kind of good stuff. And anyway, I got to go back to Jerry. Jerry, you still there?
Hey, Bill, yeah. Getting back to this fiduciary situation, one other question. Is that sanctioned with civil or criminal penalties or both?
It depends on what they do. You know, it could be it could go to criminal at some point in time. You know, and that's typically when you're stealing from a client. Or you know, criminal could be you put them into investments that they are totally not suitable for. Like a private equity investment. You know, here I'm going to buy a restaurant. Once you invest in my restaurant, oh, I'm sorry, I spent all your money, but I don't have any returns. You know, and, that kind of thing. It's all over the map. You just you just have to try to be, you know, use as much common sense as you can, and like I said, ask a lot of people. You know, get multiple opinions.
Okay. What's your opinion on whole life insurance after 65? What I'm saying, an existing policy or policies. Is the person wise to continue with them, or cash them in and go in a different direction?
Each one of those policies is going to be different. You're going to have to get a breakdown from the company and take a look at their dividend policies, what the cash values are. And there's a lot, man. That's a lot of analysis. Dude, that's a lot of work. So if somebody is interested in something like that, I can probably help you there. Because that's the industry that I actually came out of. Very few firms have traditional whole life policies anymore. But they were really good at one point in time. But you know, every case is different. The products have changed dramatically. You're literally talking about 4 to 6 hours worth of work to do a good job.
Wow.
Yeah, it's a lot of effort.
Okay. I actually have two questions now. They are both kind of centered around the same thing. When does a momentum stock not continue to stay a momentum stock?
Well, that you get to define that yourself.
Well, you have, you know, and you as well as a number of other people in the financial industry say this is a great momentum stock now, or this one should be watched, and so forth and so on. Where
they all do it differently, by the way. They've all got different.
Okay, well, generally there's got to be some kind of consensus.
No, there's not. There is not. I can tell you there is absolutely not. Some people will use if it's down 20% off its most recent high, then it's no longer a momentum stock. Some people use a 200-day moving average. Some they use a 20-day moving average. Some people use a 20-day, 50-day crossover. It really depends. You have to get them to clarify for you.
Well, I've been doing some trading in this AAOI, the applied. You had recommended it.
I've been in and out. Yeah, it's actually. I may still have it. I have to go back and look. But
okay, the way I've traded in it, and I've done pretty well, was to take a contrarian position rather than investing in it. I've been selling puts against it. Okay. And in that case, if it goes down, I get it, and if it keeps rolling, I'm making, collecting the premium.
That's one of those transactions that if I were to do that for you and lose money, I could be held accountable on that Dodd-Frank rule or the
I know, but doing it, being my own.
You
broker,
doing it yourself, yes, absolutely.
But that has worked in a number of applications.
It'll work until it doesn't. And then,
yes,
and then when it doesn't, you're going to go, wow.
Well, knock on wood, it's been good for 10 out of 10 in the last 6 months.
Hey, let me tell you something. When you say something like that, I'm going to say, I want to see all your transactions in that account. Because if I say something like that, I have to show that.
Okay.
So I'm going to hold you to the same rules that I get held to.
You'll have to trust me, William.
Yeah, I just have to tell you,
it has worked, and so anyhow,
it can work. It can work very well if you're selecting it. And I'm telling you, a 10 for 10 run is streaky, and trading is very streaky. You'll have long winning streaks. You'll have long losing streaks. If you do it long enough. And,
let me ask you this: if somebody would say it's a good momentum stock, and it's been running, and it's going to continue to run, and
here's the problem: you're trying to predict the future. That's what you're really trying to do, and I don't do that. I take a look at what's happening right now. I come up with my own definition of what the short-term trend is or medium-term trend, and when it breaks those rules, it's I'm out. I'll see you later. I do not try and predict it. You're trying to get a feel for it. That's what everybody does, by the way, and I did it for years, so don't feel bad.
Well, what I do though, Bill, is I say it's got a great price earnings
You're
ratio.
trying to predict the future. You're trying to estimate the chances of that stock continuing higher. And I'm telling you right now, the stock market doesn't care what you think.
Well, if it goes lower, I get it though, and it's still it's still a good stock.
And when it goes to zero, and when they halt trading in one of those stocks after hours one day, and it opens 50% lower, you're going to wish you'd never heard of it, and you just haven't done it enough to have that happen to you.
Mm-hmm.
Okay, I have, and if you do it long enough, it's going to happen. It's not a matter of if; it's when.
It's when. Yeah. I understand that.
So,
you're gonna have your winners and your losers, and hopefully you're gonna have a lot more winners than you have losers, or at least the winners are gonna be more profitable.
And when you're selling puts against the technology, a semiconductor manufacturer, that's crazy aggressive. Okay, that's crazy aggressive. So,
I'm not betting the ranch on it. I'm using the Bullington corollary,
yes.
no more than 1% of your trading account.
Yeah, that is the super smart thing. So you can get away with that forever. Now, you may not make a ton of dough doing that, but you won't lose a lot of money either. And if you
make over the period of a year, you'd be surprised what I'm able to make.
When stocks are running, man, and in fact, about a week and a half before Trump won the election, my momentum model took off, and I like that. It's great. I know how fast it can drop again too. So and in fact, for the past 2.5 years, it's been really tough to make money in momentum stocks. Really tough. So I'm enjoying this, and as you are too, I can tell by the tone of your voice.
Well, I enjoy trading.
Yeah, absolutely. But hey, I'm gonna have to run and take these other calls.
Okay, very good. Thanks for your help, Bill.
You calling.
I appreciate it. Sure. Yep.
Bye-bye. Bruce, sorry about the long wait. Are you there?
Hi, Bill.
Hey.
Yeah. So thanks for taking my call again. Thanks for being there, for answering questions for us.
No
here's a question I've got is I'm looking for a small portion of portfolio of companies that only do business here in the U.S.
Okay.
Like a Cedar Fair, something that's not going to be subject to international issues or something like that.
You'll be looking.
Are there other ETFs or some place I can get a list of these stocks? Companies, I should say, ETFs or funds.
Well, it's going to be hard because the S&P 500 generates 50% of its revenues overseas, roughly 50%, somewhere around that neighborhood. So you're going to be sticking with super small companies. And could you do that? Yeah. Do most small companies want to sell overseas? Yep. I can tell certain industries that would work well in to do exactly what you're talking about, and looking at all businesses in all industries. I don't think you'll ever find anybody who's got the time, money, or effort to do that, because I know what that would take. It's pretty significant, the amount of effort. I'm going to call up one of the Bloomberg people that helped me out and run a screen like that. But I would tell you that anybody that's selling a lot wants to sell as much as they can, so they really don't care where they sell. It would be a mountain of labor to do that. Financial stocks, local bank stocks, the smaller companies, they don't do a lot of overseas. A lot of them are not even allowed out of their own state. So that would be good. Real estate investment trusts typically don't invest overseas. That might be a good place to look at. Utilities, they generally don't sell overseas. So that would be, so those are all the common sense ones that would come up right off the bat. But I would probably look at their market cap, somebody who doesn't, or revenue, annual revenue. If your annual revenue is not more than $200 million, you're probably working just in the United States. And that would be
as you were talking, I just think of food stores also, Giant Eagle, Kroger, things like that. Like I said, Cedar Fair, people like that. But anyways, I did try to do some searching. I couldn't find anything myself.
Yeah.
Okay.
All right. Well, hey, thanks for calling. Yep. Have a good one. And Larry, sorry about the long wait.
No problem.
How you doing?
Okay. Happy New Year to you, Bill.
Thanks. You too.
Okay. Real quick, I see the Worden brothers have been busy. They come out with the TC2000 version 17. Have you upgraded to that?
Yeah, it's pretty cool.
Really? You like that? Yeah.
Yeah.
And they've also established their own in-house brokerage. Do you think there's anything?
That's funny. And by the way, because of that, the fundamental data that they're subscribing to has improved dramatically as far as its accuracy is concerned.
Uh-huh.
So we've been a big beneficiary of that. So I'm really happy about that. And,
Neat. All right.
Yeah,
All
that means a lot of people will not have to subscribe to outside sources now if they want to build some more sophisticated screens.
Mm-hmm. Okay. You really got my curiosity going with the upcoming Look Out for the Bull website. I can hardly wait. Will you offer like fee-based subscriptions for any scan products, or is that not part of the deal?
That's actually what it is. So
okay. Neat. All right, fine. All right. Okay, real quick, I think we're coming to the end of the line here. I suppose you heard Charles Schwab reduced fees this week. You think that's going to impact the rest of the industry with price wars and additional fee reductions and things?
Interactive Brokers has only been 0.003 cents a share with a minimum of $1 for years. So their execution platform is awesome. I use it for a hedge fund, and so if cost is the key factor, then Interactive Brokers would have already put these guys out of business. So
neat. Okay.
Yeah.
All right. Well, I won't press your time here. Thanks a lot. Looking forward to the upcoming seminar and the new site. Thanks a lot.
Well, thanks, Larry. Have a good weekend. And the rest of you, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. We're also on iTunes. So if you want to, the podcast is available on iTunes. Just search for BullingtonCapital.com if you wanted to listen to anything again. Or you can go to my website. It's also uploaded there every week. And again, go back to the website to find out about that seminar that's coming up. We got the music starting here. That means the show is over. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.